We'll cover several things in this update, but primarily we're going to focus on some developments recently with the VIX that may or may not impact the risk-reward ratio or outlook for the stock market. Quickly, here's the box that we've been talking about since late last year. The weekly high last week was 1368, which puts us in this range here. The fact that we're hanging around 1368, which would be above this yellow box, may tell us that if we come down, we'll probably come back up, but it's a little bit too early to tell. But we have to be open-minded relative to higher highs later in the year. In addition to talking about the VIX from a DeMark perspective, we're also going to take a brief look at the transportation average. We'll also talk about how we plan to potentially profit if the markets do pull back. And we'll review Europe's calendar in terms of what's coming up in the next few weeks. This is 2010. This is 2011. Top chart is the S&P 500 index. The bottom chart is the VIX. These are DeMark exhaustion signals or buy setups for the VIX. When the VIX is low, fear tends to be on the low side. This means that stock market participants, when the VIX is low, think that volatility looking out 30 days will be low. So this can be a measure of complacency when the VIX is low. Everything's fine. Stock market's not going to be volatile. Here we got a DeMark exhaustion signal. The stock market, the S&P 500, had a correction soon thereafter. Here's a DeMark exhaustion signal. Stock market corrected soon thereafter. DeMark exhaustion signal on the VIX. Stock market corrected again soon thereafter. The point of bringing this up is we have currently these signals on the VIX. We've got a buy setup, an exhaustion signal for the combo, aggressive combo, sequential and aggressive sequential, which means it's probably not a good time to be thinking about going long, at least until these are cleared up and these exhaustion signals that we have today on the VIX align with other things that we'll talk about in this video that point to a possible correction sometime in the next week to 2 weeks. Here we're calculating the risk-reward ratios if you bought the S&P 500 on the dates where we saw the DeMark exhaustion signals for the VIX. So these 3 dates here align with the blue arrows that were pointing down on the previous chart. We also went and looked at the early stages of the bull run in 2009 because you can make an argument that we're in the early stages of a longer-term bull run, and it's irrelevant where the VIX is right now because we're probably going to go higher. These numbers here show you if you bought the S&P 500 on Valentine's Day 2011, what were the returns in the S&P 500 looking out 3 days all the way out to 60 days. When you calculate the risk-reward ratio, if you bought on these days, these are days that are similar to what we have now. These are periods where you had DeMark exhaustion signals or potential buy setups on the VIX. Here are the risk-reward ratios down here. They're very unfavorable looking out 45 days. They improve a little bit looking out 60 days. Another interesting takeaway here is when did the market reach its maximum period of loss? So in this case, it was 30 days out. The S&P 500 lost 5.66%. This case, it was 45 days out, roughly 7%. Here, 30 days out, a little over 6%. Here, it was 10 days out, and it was about 5.5%. If you take these numbers that we just went over, the average of them is a 6% loss, and the median of those 4 numbers is also a 6% loss. So you can make an argument that a 5 to 6% pullback over the next 10 to 45 days would align with these recent historical cases. Just wanted to give clients an opportunity to see how we are tracking current opportunities in the market. This is part of the CCM Asset Allocation model. These are ETFs here that we follow. They're stack ranked based upon historical studies. The point of the exercise is your big winners tend to come from either the first quadrant of this list or the bottom of this list or the fourth quadrant. How that helps us is if the base case plays out and we get a pullback, you would start with this list as potential candidates to buy on a pullback if you felt like it looked like we were going to go on to make higher highs. If we get a correction that lasts longer, maybe something on the order of 11%, assets here that are currently out of favor, something like the VIX ETF, might be good buy candidates. We've also got all of these symbols here where we're tracking here daily, weekly, and monthly DeMark counts. Now we're looking at a chart of the present day VIX. This is a daily chart. This is the VIX right here. Takeaways are fairly simple. Notice how price on the VIX is falling, which is indicative of complacency. Might also want to note that the VIX did get a little bit lower relative to the previous charts that we were looking at on the historical reversals on the S&P 500. So it's possible that we've got another leg down here in the VIX, even if we see a correction. Price of the VIX coming down. You've got a divergence here with RSI. Price is making a new low. RSI is actually making higher lows here. That tends to be a little bit bullish, telling you might be getting near some type of bottom here. Same thing is true with MACD. Price coming down. Look at the divergence. This green line here on the MACD histogram. This is a bullish divergence that's been taking place for quite some time. This indicator down here is a little bit like ADX. It measures the strength of a trend. And one quick takeaway is you can see here that the red line's coming down, green line crossed it. That's very, very similar to what we've seen in here. And notice here, this is the S&P 500 index. The S&P 500 corrected when we had a similar setup here and here. Quickly, a few topics that we've talked about in a little bit more detail on short takes. You can go to our website and get a little bit more information. The summation index, or market breadth, which talks about the number of stocks participating in the rally. The summation index has rolled over recently, which can be indicative of a weakening market and can be indicative of a market that may be topping soon. Sentiment, we've covered on short takes. The VIX that we talk about today also looks at sentiment when people get complacent or overly bullish, especially when you get near extreme readings. That can occur near market reversals, both bottoms and tops. We've covered the strong trends in the current market. The reason for bringing that up is the current profile of the market says that even if we get a pullback, the odds are pretty decent that that would be a buying opportunity and the markets would go up and make another high. But we'll just have to see what happens. Right now, the base case is that most markets will correct somewhere between 5.5% to 11%. We would think the S&P 500 would be more in this region here, and this would be your more volatile indices and sectors of the market that might go here. But we'll keep an open mind and see how things unfold. Now we're looking at the S&P 500 here on the upper chart. This is the transportation index here. You'll notice with these blue dotted lines that the S&P 500 and the transports have a tendency to peak in unison in typical markets. Lately, we have a huge divergence here. The S&P 500 here has been rising, and the transportation average has dropped 5.5% since it peaked in early February. So this divergence could be a yellow flag telling you that the S&P 500 is going to catch up. The bullish interpretation of this could be that markets have a tendency to move in increments of roughly 5.5%. So you could also make an argument that in the short term, it's the transports that are going to bounce, and eventually the correction could be deferred. But right now, this tends to lean in the bearish camp. Here are the transports here. Also notice that on Friday, February 24th, you can see the market closed here at its lows of the day. It gave back a lot of gains on Friday. And notice the high volume sell-off here. If this transportation average takes another 5.5% down, it would take you down to roughly 86, which would make sense because markets have a tendency to move in 5.5% increments. The other thing that's interesting to note, if we came all the way down there, That would take us all the way back to where we were on December 19th. Not so sure that that's logical relative to where the market is, so keep an open mind about where this goes short term. It could be that this is going to bounce and this is going to go higher, then they're both going to come down. But right now, this is a bearish divergence between the transports and the S&P 500 index. This is what's slated to occur in Europe over the next few weeks. We don't want to spend a lot of time on this. These are just some things that we'll be watching in terms of managing portfolios. The big one this week is February 29th at 5:15 in the morning. They're going to announce the take-up for the ECB's next giant money printing extravaganza, where they will print money and offer the second round of 3-year unlimited loans to banks. This is very, very important. We'll go over that in the next series of slides in terms of how money printing has impacted the markets. The other big one here is March 20th is when 14.5 billion, that's in euros, worth of Greek bonds mature. With the ECB set to deliver the second LTRO this week, it's helpful to go back and review how we got here, because we have to understand press conference risk and money printing risk from a bullish perspective. Here's the market here near the October lows. What we're going to review here is what has changed. Has it been promises, fundamental changes, or money printing that's gotten the market from here to here? This is an excellent example of press conference risk, and we bring this up because we need to understand going forward, press conference risk is not going away. Here was the market here on October 4th. Look how low it got. And basically what happened was the market was on the ropes here. There's not a bullish thing about this chart or a bullish thing about the technicals here. But a story was basically leaked, because what happens is they see that the market's on the ropes and they say, look, we got to get something out there. So somebody picks up the phone and calls a reporter and says, look, you need to get this out, and you need to get it out before the market closes. Here's a quote from October 4th, which is this date of 2011, from the New York Times. Less than an hour before the close, the index was down 1.9%, which is right here. But in the final 45 minutes of trading, it rose 4% after a report said European officials were discussing plans to recapitalize the continent's banks. After the announcement was made, the news leaked 45 to 49 minutes before the close. Nothing really had fundamentally changed to spark this rally. It was just simply a statement that included the term bank recapitalizations. So the market got all euphoric, and here was another piece of good news here. This was where we had saved Europe and come up with the final solution, and the market went through the roof here, and this is the New York Times date here. Once the euphoria of the "we've saved the world" announcements came out in the middle of the night here, the fundamental problems started to rear their ugly head again, and notice the vertical plunge here, close near the low, close near the low. This is the Friday after Thanksgiving. On this Friday, the ECB reiterated that we don't print money in Europe. That's not what we do. Things did not look good the Friday after Thanksgiving. The next week, the rumors started that the Fed was going to come in and do something. On Wednesday of that week, sure enough, the Fed announced swap lines. So this is a money printing week. So you've got market holds here from a New York Times story about bank recapitalizations. Market holds here on this week because the Fed decides to print money. Here is where the market decides that money printing really in the long run, swap lines from the Fed really not going to solve things. Market starts to come down again in a bearish manner here. What saved the market here and started this huge rally? Money printing. This is where the ECB decided they were going to offer unlimited 3-year loans, which basically says they told the market we're willing to print unlimited amounts of money relative to these loans, and we sparked a huge money printing induced rally here. The point of bringing all this up is you have to ask yourself, how did we get from here to here? Here's an announcement, a promise to recapitalize banks. Here's the Fed printing money. Here's the ECB printing money. And here we are. What relative to Europe's fundamental problems has changed between here and here? The answer is really very little. And why we bring that up is it lets us know that we have to question the sustainability of this type of rally since it's based primarily on money printing. We can also learn in terms of how to make money going forward. What's shown in this chart here is probably indicative of what we're going to see going forward. What we're going to get is deflationary scares, money printing, money printing, money printing, and then at some point this will probably be followed by another deflationary scare. So we've got deflationary cycles where certain assets will do well, money printing induced or inflation friendly cycles where certain assets will do well, which speaks to the need to be flexible and include both inflation-friendly assets and deflation-friendly assets in our portfolios. These cycles will probably be shorter and shorter over time as the impact of the money printing becomes less and less relative to the influence on the markets. It's interesting to note that we're not alone in terms of questioning whether fundamental problems have been addressed or not. This was just this weekend. The German finance minister told bankers in Mexico City that he was worried that fundamental problems in Europe had not been solved. We've had a lot of money printing in Europe. We've done very, very little to address structural or fundamental problems. The other ironic thing is, remember what sparked the whole rally off the October 4 lows? It was a promise to recapitalize the banks in Europe, and they've really done very, very little to date in terms of recapitalizing the banks. This is from the Stanford Graduate Business School, February 13th, so these are relatively recent quotes. Clearly, European banks are undercapitalized. The fact that they haven't failed doesn't mean that they aren't under extreme stress. It's a dangerous mentality to see how far you can kick the can down the road. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.